Now we've got to talk about how to calculate the straight line depreciation. Remember, this is the only one we'll talk about, okay? So you may see a question on your exam or your quiz that says, hey, there are other types of depreciation. You would do well to know what those are, but we don't need to know how to calculate them. This is the only one that we really want to know how to calculate. And we've been doing this since like chapter 3, right? We've already calculated depreciation in chapter 3, so this is just really should be more of a review for you. So let's say Little King Sandwiches purchased a new vehicle to use for deliveries. Okay, so this is used in their operations. We use the following information. We calculate straight line depreciation for this long-term asset. This is the one thing that's changing, right? This is the new kind of, this is the new loop that they throw at you, right? This is the wrench they're going to kind of throw in the cogs for you, okay? So you've got your cost of the new truck. This is what you paid, okay? And then you're also going to have your estimated residual value, what you think you can get for it, okay? When you sell it at the end of its useful life, okay? This is what you think you'll get for it at the end of its useful life. You have to include that when we're doing straight line depreciation. This is a minus, right? It's less. It's the cost less that estimated residual value, that salvage value, and then you get an estimated service life, 5 years. They tell you we think we will use this equipment, this asset for 5 years. So we get our depreciation expense by doing the following. We take our asset cost, this right here, and we reduce it by the residual value, this here, the salvage value, what we think we'll get for it when we sell it, and then we divide it by the service life, right here. Okay. What this is called is the depreciable cost, okay? So 1 minus 2 here, your step 1 minus your step 2, your asset cost less your residual value, that's what we call depreciable cost. So if you hear us say that, that's what we're talking about. This is the depreciable cost. You'll also hear it called depreciable base. Okay? That's typically how I refer to it. It's just the cost of your asset, what you paid for it, less what you think you'll get for it when you sell it. Okay? Divide that by your service life, and that gives you your depreciation expense per year. Right? This is per year. So 40,000 minus 5,000 is 35,000. 35,000 divided by 5 is $7,000 per year that you will recognize as an expense. Okay, you will depreciate this particular asset by $7,000 per year. Okay? So what's that look like? Well, this is what we call a depreciation schedule. Okay, you would have this worked out for yourselves. Okay, and this just tells you because it's straight line, your expense is the same every year, okay? If you had a graph of depreciation, right, where these are your years, and this is the cost every year, the graph looks like that, okay? It's the same amount every year, okay? This one, though, I'll give you a little note. First of all, book value is the original cost of the asset minus any depreciation associated with it, right? So you get your book value here. One note here, you may notice this is strange. They're saying the depreciation cost of the depreciable base times the depreciation rate. Well, the way you find your depreciation rate is you take 100%, because what are we trying to do when we depreciate an asset? We're trying to fully depreciate it 100% down to its book value, right? And then you divide that by the number of useful years, okay? You divide that by its useful life. So that, in this instance, they told us it was 5 years. You get 20%. So they're just saying you are going to depreciate this by 20% each year. This would work regardless of what your year was, your length of time, your useful life. Sometimes it's just easier, though, if you get a funky number. Let's say you've got a 3-year or a 5-year, 6-year, 7-year, whatever the case is, and you just kind of get a weird number, right? Sometimes it's just easier to divide your depreciable base by your number of years in your useful life, okay? So here you can see your book value slowly decreasing. Please note, this is important. At the end of its useful life, you want its book value here to equal its salvage value or its residual value, okay? So your book value will equal the salvage value at the end of your useful life. There is one more hiccup that we have to talk about, okay? Sometimes we will have to do what is called, and most times, honestly, they don't, once you learn straight line, they like to throw something more difficult at you with it. This is called partial year depreciation, okay? You're not always going to buy an asset perfectly at the beginning of the year, okay? Sometimes you're going to buy it partially through the year. Let's say that you run your business based on a calendar year, and you buy an asset in March, right? You don't own that for 12 months. So you can't depreciate it for 12 months. What you do own it for is some part of that year, right? And if you bought it at the beginning of March, then you own it for 10 months out of the year, and you would have to take 10 over 12. That N equals the number of months, right? N in this class is almost always going to be how long you've had something, okay? So, and 12 obviously is the months in a year, right? Okay, so this is just a table. Get familiar with this table, okay? So let's say that Little King Sandwiches purchased the vehicle on November 1st of year 1 as opposed to January 1st of year 1, okay? In this example, Little King would only need to depreciate the vehicle in year 1 for the number of months it was in use. That's what we're doing with this partial year depreciation, or 2 months, because they bought it at the beginning of November, November 1st, so they owned it all of November and all of December. 2 months, okay? So we would multiply the depreciable base, 35,000. So this is the same vehicle, except now we're going to multiply it times 2 over 12. 2 is that N, right? Okay. And that gets us the depreciation for that year. Now notice, you are not fully depreciated at the end of year 5. You have some amount of depreciation in year 6 here, okay? Part of this asset's use has run into year 6, and that's okay. Don't freak out about it. Don't worry about it. Just know that you have to account for those last 10 months that you owned it during year 6, okay? So just a note, I know you guys laugh at me. I know it seems goofy, it seems silly. When I tell you count on your fingers, please just count on your fingers when it comes to this. When it comes to deciding how many months you've had something, it's going to eliminate any kind of I'll just say the occasional allocation error gets eliminated by going November, December, okay? Or, November, December is easy. That's 2 months. But what a lot of people will do is they'll say, oh, we bought this in March. Okay, March is month 3. There's 12 months in a year. So that means we've had it for 9 months, right? If you bought it on March 1st, no, that's wrong, okay? What it actually means is you've had it for March, April, May, June, July, August, September, October, November, December. You've had it for 10 months, okay? So just be careful. I know the counting on your fingers thing seems a little silly, a little childish, but I still do it on occasion just to make sure that I'm getting the number of months right.